All right. Good afternoon, everyone. This is Joe Bacella here at Chaikin Analytics, and I'd like to welcome you to our presentation of Turn Volatility into Profits, the keys to trading in a chaotic market. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics. Throughout the presentation, please submit your questions using the Zoom Q&A window, which is available in the upper left-hand corner of your screen. This webinar is being recorded, and a copy will be sent to everyone who is registered. Before we get started, we have the founder of Optionetics on with us today, Tom Gentile. Tom, take it away.
Hey, thanks a lot, Joe. And hi, everybody. Optionetics and Tom's Trading Room. Glad to have you guys here. You know, I have never done this before from our room, from Tom's Trading Room, inviting anyone else in to speak about software, because of all of you know, we all typically use Tom's options tools. You know, I could talk about Marc. You know, Marc and I have known each other for a long time. I mean, he's been on Wall Street. He's been a trader, a stockbroker. He's done all kinds of stuff. If you look at about Marc Chaikin, you can kind of get an idea of what this guy's done. But I've known him for a while. You know, he lives in Philadelphia. I see him as often as I can, which is typically when I take that corridor from Florida up through New York. But the reason I brought Marc on today is because I want to share with you something that you may not know, and that is that I use Marc's software, Chaikin Analytics. I think it is really a great complement in what it does compared to what we do at Tom's Option Tools. And so I thought maybe some of you in the room would really kind of gain some insight on this, and you could see what I see. So without any further ado, let me go ahead and introduce Marc Chaikin.
Tom, thank you, and welcome everybody. It's been a volatile market, so we're going to try and show you how to turn volatility into options profits, because trading in a market like this requires some discipline, some tools, and we're going to show you an approach to analyzing the fundamentals in conjunction with the technicals is very complementary to what Tom's doing with Tom's trading tools. And for the Optionetics community, I think this is going to be an eye-opener. So
and
a little
Marc,
bit about...
you know, just offline before you get started, you know, you and I are basically doing the same thing when it comes to actual options in this volatile market. So I want everybody to pay attention to exactly how Marc's trading, because you're all going to jump up and you go, yeah, we already know how to do that. But doing it with this software is kind of something really cool.
Well, that's good to hear. And it's going to draw on 50 years that I've been trading on Wall Street, 45 years using technical analysis. And when I headed up the options department at a brokerage firm called Tucker Anthony and R.L. Day, had over 250 brokers, tens of thousands of clients who were trading options. And back then, technical analysis was the only thing that stood between them and going broke in the options area. They didn't understand one key thing, and we're going to show you what that is. And we've now added another tool to the technical arsenal to give people that edge that we're going to talk about. Along the way, I've been mentored by some very smart and successful institutional investors. Some of them were clients, some of them were colleagues of mine. And the reason that's important is that what we're going to be looking at today, the Chaikin Power Gauge rating, is the culmination of my life's work. I basically drew on everything I learned from very successful investors and traders to build a fundamental tool that does the heavy lifting for you, so that when you trade options, you know that you're trading on the right side of the fundamentals. I can't tell you how important that is. Now, we're going to cover 5 keys to successful options trading. So first and foremost, we're going to show you how to find bullish and bearish option candidates with the Chaikin Power Gauge and our proprietary way to analyze relative strength to the market. I'm going to show you about Chaikin Money Flow and how it can help you anticipate future price movements. Now, I know all of you are familiar with Chaikin Money Flow because it's on your online brokerage platforms, whether you use Thinkorswim or Schwab or TD Ameritrade's other platform, anything, TradeStation. Chaikin Money Flow has been there for over 35 years, but we're going to show you a very different look, a secret trading pattern that we only exposed to institutional investors in a prior life. I'm going to show you how rules-based exits and entries are really critical, especially in a volatile market. And then spend a little bit of time focusing on playing good defense, because as the markets get choppier and volatile, you got to avoid landmines that can destroy your profits. And finally, probability-based options trades. Really, as Tom says, the key to making money, what he does every day. Now, we'd like to start out with a poll by asking you what risk you see for stocks in the months ahead.
All right, and so we have a poll question prepared for you. We have 4 different options that we've been hearing a lot of lately, but we're interested in hearing from you. So, interest rate spike, excessive valuations. We heard that a lot about tech over the past several months. A recession possibility, or of course, probably the news of the day today, or at least the past few weeks, tariff war. So take a moment, go ahead and respond. Let us know what you think is the most pressing risk. We'll give this just about 5 more seconds, but let us know, and we would love to take a look at the results once we're finished. And I still see a few more votes coming through. Once that slows down, we'll actually take a look. All right, and we'll call it there. And Mark, it looks like there is one clear winner.
Tariff war. And what this tells me is that people are watching CNBC and looking at the headlines. And that's one of the things that we want to address in today's webinar. It's something I call headline risk. The ability of the news media, the 24/7 talking heads cycle on TV to influence our trading and take us out of our plan, take us away from what we do well every day. So let's start out, because the market really has been on a roller coaster, by looking at the market. And what we're going to see in the next chart is that we've gone from an uptrend on autopilot in 2017, when we didn't even have a correction of 3% in the market, to a roller coaster of a correction. And it's caused people a lot of concerns. So let's take a look at a 1-year chart of the SPY, the most actively traded instrument in the US markets. The spider is a way for institutions to get instant equity exposure. Let's say they sold 5 million shares of Facebook at Fidelity and they want to keep long exposure to the market. What do? They'll go in and buy SPY. And so for all of the early part of 2017, plus what we see here on the chart, the spring and the summer into the fall, Chaikin money flow, big peaks and mountains of green, is telling you that institutional investors were buying the SPY because they were bullish on the market. Now, the SPY typically fluctuates around the 0 line. So normally you'll see periods of red in individual stocks and ETFs. What we see on this chart is that we had that very smooth autopilot kind of advance until we got into December, when we just took off like a rocket. Now, an old mentor of mine, Stan Burge at Tucker Anthony, used to call this a French curve or a hockey stick formation. And a hockey stick formation just cries out for a correction. The problem is you don't know when. So how many of you have had that problem over, back in December, January? You knew the market felt high, the tech stocks were booming, but you didn't want to miss out on that wonderful exhilaration of seeing your portfolio jump 1, 2, 3, 5, or 10% in a day. So it's a problem, and the market solved that problem by starting a little bit of a correction when it peaked on January 26th. And what probably would have been a normal pullback of 5 to 10% got juiced, got energized by a blow up in a very esoteric exchange traded note that enabled commodity trading advisors and hedge funds to bet on low volatility continuing. And that forced a lot of margin liquidation, margin calls, as people unwound billions, tens of billions of dollars. The estimate is $20 billion worth of positions tied to these notes. And so you had a decline of more than 10%. As we'll see in a minute, that speaks to a different kind of bottoming process than we saw in 2017 or 16. So we rallied up, but look what happened at Chaikin money flow. Didn't go positive. The institutions weren't buying into that rally. It might have been short covering or the public, but that wasn't institutional buying. Then you made a higher high, and as Joe pointed out, tariff wars became the headline of the day. President Trump decided to implement what he had telegraphed and talked about all through his campaign, the fact that China's been taking advantage of the US, stealing intellectual property and dumping goods. And so we started hearing about tariffs, and then they started being implemented. And then yesterday, as everybody knows, the Chinese retaliated and we got a big, huge sell-off. But guess what? Looks like we've formed what we call a W bottom. We're going to look at that in a minute. So when I took this chart, the market was up 1.13% today. So we got a great follow through on yesterday's reversal. We finished up only 0.7% higher, but still a nice day. And we ran right up into resistance in the 2670 area, 2675 on the S&P 500 index. But look at Chaikin money flow. It stayed red. So we're cautiously bullish here. And we've been saying now since that decline in February that you don't need to chase stocks. You want to buy weakness. And that's what this webinar is all about. How you take advantage of volatility on the downside to buy stocks at bargain basement prices. But let's take a look at a longer view. This is a 5-year chart of the SPY. And we've labeled the bottom since 2013 either with the letter V or the letter W, because declines of 5 to 10% historically end in the form and shape with the letter V. That's why you hear the phrase buy the dips on TV, because you can confidently buy those dips expecting that the market will return back to a new high within a month. But W-shaped bottoms occur when you've had a decline on a closing basis of more than 10%, but less than 20%, because more than 20% is a bear market. So we had a W bottom in late 2015 in August, September, and then we had a second W bottom in February of 2016. Typically, the decline is 13%. Takes 2 to 4 weeks, 2 to 4 months rather, and then you return to a new high within 3 months. So that's where I think we are now. We made the low within the volatility bands yesterday. That's important because spike lows tend to happen outside the volatility bands. Notice how on both of those bottoms, sorry about that, I've got my hyperactive mouse from Apple. W bottom, that final low, you want to see it within the volatility bands. We use Keltner channels, could also be using Bollinger Bands. The key, though, is you want to see that bottom made with less panic, therefore within the bands on lower volume. We think that's what we're seeing now. Yesterday's key reversal day with a follow-through day today sets us up to break out on the upside. When will that happen? Probably when earnings are reported next Friday from the major banks. That starts earnings season. So let's just look at these pullbacks and put them into perspective here. We've circled the pullbacks since the bull market began that ended in the shape of the letter W, and they're all between 10 and 20% on a closing basis. And this will be the 5th one. So they're not uncommon. And the reason that's important is you got to take this stuff in stride. It's painful when you're living through it, but you got to learn how to put it to your advantage. Notice how the other declines of less than 10% all ended in a V-shaped bottom. So now we've sort of set the stage here. And the final piece is, what is the bond market doing? Because for a while, the bond market was driving the stock market. The initial decline in February started when bond yields ticked up toward 3%. Then the bond market started to rally. We had about a 5-week rally, and that was blamed for the second decline. So bonds were blamed when yields were going up, and then they were blamed when yields were going down. The bottom line is interest rates are going up. The Fed has told us that. We have a strong economy. Jamie Dimon, CEO of JP Morgan, who's a really thoughtful man, one of the best CEOs in the finance industry, maybe in America, said today that people aren't giving the Fed credit for the fact that they may have to raise rates faster than they've been telegraphing. One way or another, though, interest rates are going up. The reason that's important is because there are 2 bullish scenarios for stock prices. Most bullish scenarios, what we saw in 2009 when the bear market ended to 14, falling interest rates and rising earnings. We're now, and have been since 2016, in the second most bullish environment for stocks, higher rates and rising earnings. This chart is courtesy of Bank of America Merrill Lynch. Now, why are higher rates bullish because they reflect a strong economy. This is really critical. And when you've got earnings rising, and earnings for the fourth quarter were fabulous, analysts are expecting an 18% increase in earnings in 2018. Part of that is the tax cut. They're expecting another 7 to 9% increase next year. So earnings are going up. And as long as interest rates go up slowly and don't jump up dramatically above 3%, we're in a very bullish scenario for stock prices. Now, if I haven't convinced you that we've probably made a bottom and we're going to move higher, here's how you can profit from a test of the lows. So this is one of the first options ideas. Now remember, Chaikin Analytics not registered with any state or federal agency, so these are just ideas, not recommendations. Now what we're looking at here is something that I pulled just near the close. It's called a vertical put spread. It's a bearish put spread on the SPY. And what you're doing here with the index at around 266 is betting on a 4.5% drop in the market back down, testing the old lows at 25.33. So you buy the 266 put and you sell the 254 put against it. Now, you accomplish two things here. You reduce your cost because you could buy that put outright. This put expires on May 18th, so you're giving yourself 6 weeks to get a good retest of the low. You reduce your cost from 554 to 308, but you also increase your rate of return on the same move in the stock by almost 200%. So if the S&P drops from 266 back down to 254, make a very, very high, almost a 300% rate of return on your money. But most importantly, look down at the bottom of this simulation from Options Play, which is a module that we've bundled into Chaikin Analytics. You make almost 3 times the return, 200% better than if you bought the put outright. So we really like vertical put spreads in the direction of either our market view or the individual stocks that we're going to look at. So in this webinar, we're going to show you how to identify stocks like Progressive, big insurance company. Everybody's seen those commercials with Flo, very humorous commercials, but they also accompany a very, very strong stock. And we got one of our relative strength buy signals about a month ago, and the stock was jumped up on a monthly earnings report. Progressive reports their earnings every month and their sales and revenue. Jumped up, gave a signal of 56, ran all the way up to 62. That's a nice trade in a market that's still trying to find a bottom. Now, we've covered a lot of information, and there's a lot more to cover, and there's a lot more you have to contend with every day as a trader. There's too much information. There's just a flood of data to deal with. People call it information overload. So at Chaikin Analytics, our solution to information overload is the analytics workstation for both iPad and desktop with Options Play bundled in. Because Tom Gentile and the tools that he provides and the guidance and the education can only follow so many stocks, but there are about 1,200 stocks with actively traded options, over 2,500 stocks with options altogether. So you need a centralized marketplace, centralized place to get all your information. And that's what Chaikin Analytics is all about. And of course, validation is very important because you're on a webinar with someone you may have never listened to before. So why should you take an hour out of your life after a pretty grueling 2 days in the market? Because we've partnered with some really smart people. Jim Cramer, obviously our host, Tom Gentile, and the Optionetics people embraced us. And we've been featured in Barron's and Forbes and on CNBC. So there's a lot of validation for what we're doing. As you'll see later, Benziga, who's a news aggregator and an instigator of news stories, gave us a wonderful award last May. And I think the best accolade I've gotten in the last 2 years came from Tom. Almost 2 years ago when he said, you need an edge to trade successfully, and Chaikin Analytics can give you that edge. Now, what is it that Tom was talking about? Well, we call it the directional edge. It's combining fundamentals with technicals into a quantitative model, layering in some buy and sell signals for better and more disciplined exits and entries. And this is what I found was missing when I was trying to steer over 10,000 options traders at Tucker Anthony to better trading habits, better principles. They didn't understand the importance of a directional edge. Now, as I said, back then it was technical analysis because that's what I was doing. Now we've got a way to combine fundamentals with technicals to give options traders that directional edge, because without it, or without someone like Tom Gentile guiding you, 95% of options traders lose money. Create a lot of business for the online brokerage firms, but if you're not using something that gives you that directional edge, you're not going to make money consistently. So our answer to the information overload problem and our directional edge for options traders is called the Chaikin Power Gauge rating. It's a simple display, but very powerful. Number crunching is going on under the surface. I've said many times on webinars like this that the Chaikin Power Gauge rating is like a Chevrolet with a Ferrari engine under the hood. And as you'll see, it can be your GPS during earnings season. It can guide you towards stocks that are likely to outperform or underperform. So you can take low risk positions ahead of earnings using options to benefit from big spikes up or down. And we'll show you a couple examples of that. Now, what's in the Chaikin Power Gauge are four primary factors that cover value, growth, technical, and sentiment data. And within each of those four primary factors, 5 sub-factors. Now, as I said earlier, the factors in the model reflect what I learned from working with successful institutional investors over a 30-year period. This model works because it's based on how Wall Street works. These factors are what successful investors like Warren Buffett look at every day to make investment decisions. Problem with fundamental analysis, though, is everybody has biases and different styles. So you can be a value investor, a growth investor, earnings momentum, technical trader. When I set out to build a model 8 years ago, I wanted to have a model that could like value stocks or growth stocks, small caps or large caps. And that's what the Power Gauge rating does. It doesn't care where the opportunity is. It finds it by ranking 3,000 stocks in the Russell 3000 based on these factors, and then comes up with a simple rating that you see on the left of the screen. Tells you which of the factors are contributing to the rating and makes it easy for you to incorporate fundamentals into your decision making because you don't have to do any of the work. The Power Gauge does all the work for you. When we first launched the Power Gauge in 2011, we got feedback from people along the lines of, it used to take me 2 hours to analyze a stock, and now you guys do it for me in seconds. So 5,000 stocks. Rating is updated every night, very timely if analysts are changing their earnings estimates or company reports a positive or negative earnings surprise. And the performance bears it out. From 1999 through the end of 2017, the average very bullish stock in the Russell 3000 was up 20% a year. The average very bearish stock up only 1%. And that's after a 9-year bull market. So if you're an options trader, the answer is pretty simple. Trading on the long side, focus on the very bullish stocks. Trading on the short side, focus on the very bearish stocks, because as we saw in 2015, when we had a bear market in small caps and in energy stocks particularly, if you're on the wrong side of bear market in bearish stocks, you can get destroyed. And that's what happened to a lot of people who were trading fracking stocks too late in the game, like Kinder Morgan and Range Resources. Average very bearish stock in the Russell 3000 was down over 17% in that year, the S&P 500 was only down 1%. So you needed to avoid the bearish stocks. Now, one final piece of validation. We entered into a partnership with NASDAQ 4 years ago, created 3 NASDAQ Chaikin indices, large cap, small cap, and dividend achiever. They have a 4-year real-time track record. They're buy and hold portfolios. So even though the power gauge helps traders, it can also help you build a portfolio for your 401k plan. And all 3 of these indices have substantially outperformed their benchmarks to the point that in February of 2017, New York Life, the largest mutual insurance company in America, and their investment subsidiary Index IQ licensed all 3 NASDAQ Chaikin indices. So investors can now buy a small cap ETF or a large cap ETF, which have a portfolio of stocks based on the Chaikin power gauge rating. Now, this isn't a recommendation to buy these ETFs. This is meant to validate the power gauge rating because there's now $750 million in these 2 ETFs less than a year after launch. The CSML was the 3rd most successful ETF launch of 2017. The power gauge works. That's why a big institution like NASDAQ partnered with us, and Index IQ launched these exchange traded funds. So let's get down to how you make money as a trader with the power gauge. First and foremost, successful trading demands a disciplined methodology. So for us at the top of the pyramid, it's the Chaikin power gauge rating. And we also like to see industry groups that are strong to trade on the long side or weak to trade on the short side. At the bottom of the pyramid, just 2 technical indicators, Chaikin money flow, which many of you have told us you've been using for years, and Chaikin relative strength. And right in the middle, that sweet spot, Chaikin buy and sell signals to give you a timely entry point. So based on that, we've created 2 patterns that we think encapsulate what you need to get that directional edge. Classic Chaikin bulls are stocks where the fundamentals are strong, so the Chaikin power gauge is bullish. Stock is outperforming the market, and Chaikin money flow is strong, telling you that the institutions are buying the stock. So here's a poster child for the classic Chaikin bull, E-Trade Financial. We read a chart from the bottom up. So let me take you through a very quick reading because it really is quick every day. You can loop through 20 stocks that you're thinking of trading on the long side in less than 5 minutes at Chaikin Analytics. So at the bottom is the power gauge rating as a ribbon that goes from red to yellow to green. When it's green, the fundamentals are bullish, and the fundamentals have been bullish for E-Trade since early June. Right on top of that is a heat map that tells you whether the stock, in this case E-Trade, is outperforming or underperforming the market. Look back over 6 months, convert the numbers that you would typically see in Investors Business Daily for relative strength, and convert them into a heat map. That's one additional way we solve the information overload problem. And then jump up over the overbought, oversold to Chaikin money flow, because that tells you whether the institutions are buying or selling the stock. And in the case of E-Trade, institutions have been aggressive buyers of the stock for the last 10 months. And then we get to the price chart. Notice how we've analyzed the chart from the bottom up. That's that edge that Tom was talking about when he gave us that wonderful testimonial. The ability on one chart to see the fundamentals and the technicals, and then look at the price chart. And we do a couple of extra things. We analyze the last 4 earnings reports for you and color code them either red, gray, or green, depending on whether a stock outperforms or underperforms Wall Street estimates, because one of the 20 factors in the Chaikin model is earnings surprise. They always come in bunches. Notice you've got 4 earnings surprises on this chart. Right at the top, we see that E-Trade is due to report on Thursday, April 19th. And we've got a green exclamation point because we've got an earnings alert indicator that tells you whether the stock is likely to outperform or underperform based on whether analysts are raising or lowering their estimates and the history of earnings surprise. And what this is saying is analysts are raising their estimates and our earnings alert is bullish. And so we got a nice move. I made E-Trade my bullish stock of the week in my weekly market letter called Chaikin Market Insights on Sunday. Said to buy it on a dip under 53. It did that on Monday. And now you've taken off. And when we did this chart, E-Trade was trading at about 57. So you had a nice trade if you had the discipline to get in on the weakness. And then notice that as you pulled back to oversold, Chaikin money flow stayed green or positive. That tells you that the institutions are not contributing to the weakness, they're taking advantage of it. It's a very powerful pattern that we call persistent accumulation. So that's our classic bull. And it's nice to know that it's there, but how do you find them? To solve that problem, we built a screener that's very different from any other screener because it enables you to screen on the factors in the power gauge rating and the power gauge rating itself. So around midday today, I took the S&P 500 as a starting universe, required that any stock that passed through the screen have a bullish rating. I also like free cash flow. That's what Warren Buffett looks at. We're in volatile times. I want strong companies that are generating cash, not companies using financial engineering to doctor up their earnings. And then I was looking for stocks that were above a rising long-term trend line with outperformance relative to the market. We narrowed the S&P 500 down to 16 names. And we're actually going to be talking about a lot of these 16 on the webinar. You've already looked at E-Trade. We're going to talk, and Progressive. We're going to talk about Foot Locker and Michael Kors in a couple of minutes. The bottom line here is if you distill your potential universe of buy candidates for the long side of options trading down to just a few names, get to know them well, look for the opportunities that a volatile market give you, you're going to really improve the odds. Now, classic bears, turn everything I said on its head. Power gauge ratings bearish, telling you the fundamentals are weak. It's underperforming the market, and Chaikin money flow is red, not green, telling you that institutions are selling the stock. So again, read this chart on Tesaro, which is a drug and biotech stock, from the bottom up. Power gauge rating has been bearish for over a year, been underperforming the market, and institutions are selling, and then we get our relative strength sell signal. And all 6 pairs of buy and sell signals in Chaikin Analytics are explained on our website. The conceptual is there, whether you're a member or a visitor. And I'll just explain the relative strength signal because it's great for options traders. A stock that's underperforming the market moves above its 21-day average, gets overbought, and then reverses back down below its 21-day average. Relative strength sell signal, the reason I like this for options trading is the duration is 4 to 8 weeks. So you can put on an options trade with a 20 delta or a 70 delta. Doesn't matter because you've got time on your side. You can go out of the money, you can go in the money. Option premium erosion ceases to be a problem if you have confidence that a move is going to persist for an extended period of time. So this is an example of a classic Chaikin bear. Previously, we had Kinder Morgan, Under Armour, Wynn back 3 years ago. And usually we stay with a classic Chaikin pattern on these webinars for 6 to 9 months. Why? Because these patterns persist for extended periods of time, so we can keep using them as examples. Now, here's a current example of a Chaikin bear. It's Tesla. And I think any of you who've tried to trade Tesla from the short side know how difficult it's been, even though they disappoint every time they report their production figures and their earnings. So we found that using our relative strength sell signals really work on Tesla. You've got to short Tesla after it's rallied and then turn back a bit. And we've now seen a drop down to 250 on some very bad news, whistleblowers within the company. That made a, as you'll see in a minute, vertical bearish put spread that we talked about on a webinar just 3 weeks ago, very profitable. And there's another opportunity setting up here, in my opinion, as the stock rallies above its 21-day average today, to put on another put spread. So on the left is a put spread that we talked about on our webinar of 314. So less than a month ago, when Tesla was 327, put spread that was suggested by the 327.5 put expiring on April 27th, sell the 290 put against it. $1,300 you were short, in essence, 100 shares of Tesla with the potential to make almost 200%. And of course, that potential was fully realized as the stock dropped to 250. Now that it's rallied back up above 300, you can buy the May 305 put that expires on May 18th. So you're giving yourself almost 6 weeks for $1,700 for the put spread, the 305, sell the 245 against it. Look how you've cut your cost down from paying almost $2,500 for the 305 put to only $1,700 for the spread. But if that spread widens out to 60 points, look at the profits you can make. Very high percentage returns. Option play gives it a nice green with a check mark, so it's a probability-based options trade. So if Tesla goes down and makes a new low within the next 6 weeks, can make an awful lot of money as the spread widens out from 17 to 60. So that's what we talk about when we say vertical put spreads give you a way to participate in the stock on the downside, cut your cost, and improve your profitability. So 3 other patterns are embodied in these classic bull and bear patterns, and I'd like to go through them now. The first one is the dynamic duo. It's a combination of fundamentals and technicals. That's what this webinar is really all about. That's the edge that we provide to options traders. So the Chaikin Power Gauge rating tells you what the fundamental potential for a stock is, and our relative strength indicator tells you whether the stock is outperforming or underperforming the market. And power gauge rating and relative strength help you find big winners and losers when they agree with one another. Just be mindful that relative strength stands alone as a bullish or bearish indicator. This is what's known as a high momentum trade on either the upside or the downside. And we'll see an example of a high momentum trade on the downside when we look at General Electric in a few minutes. So the second pattern we call spotting personality changes. And it's really the key to making and keeping profits, in my opinion. We define a personality change as a stock that goes from outperforming the market, so relative strength is green, to underperforming the market with a red relative strength indicator. Now, here's an example of what we call a bullish personality change. It's Michael Kors, very powerful force in the apparel business. They made an acquisition of Jimmy Choo's shoe line, but it was under pressure in the spring and summer of 2017 because people were worried about border taxes. People were worried about trade wars back then as well. But the stock reported a very positive earnings surprise back here in August, spiked up, broke the downtrend, and in doing that, it started to outperform the market. Do we want to buy that spike? No. When you get a spike up, momentum breakout, you want to wait for a sideways to down pullback over 3 to 8 days. And ideally, you enter the stock on the first buy signal, which in this case is our oversold buy. That's an 8-day low in a stock with a bullish power gauge rating. You're trying to catch a bottom, a short-term bottom in a stock with good money flow and a bullish power gauge rating. And that buy signal at 43 was very effective. Stock spiked up again, pulled back, gave a second buy signal. And you see the pattern of positive earnings surprises. So even in the middle of this waterfall decline, you got an oversold buy signal ahead of an earnings report where Kors spiked up to a new all-time high of 70. Now, pulled back, gave another buy signal, and then today Coors was trading at about 65.70, near our upper volatility band. So is this a good time to buy an option on the long side on Coors? Well, I went to options play, and the answer is no. A, I don't like buying calls or bullish call spreads with the stock at the upper volatility band, but it doesn't matter what I like. Options play sort of created a probability-based matrix, and instead of being circled in green with a check mark, you've got a yellow 86 rating. So the bullish call spread, buying the 65, selling the 72.5, is not considered high probability trade. So we pass on that. But on that screener we looked at earlier, Foot Locker, another company in the retail business, also had a bullish personality change. It's not quite as strong as Michael Kors, but it had a momentum breakout signal here coming into today's trading. So do we want to buy a bullish options position on Foot Locker? Well, I typically, as I said, don't like to buy bullish positions at the upper volatility band, but options play has a mildly bullish 105 rating with a green check mark. Gives you the ability to buy the 47 call, sell the 52.5 call against it. Nice risk-reward ratio. I'd prefer to wait for the market to go sideways to down in Foot Locker for another 3 or 4 days. The options premium will start to pull in. Implied volatility will probably diminish, so you'll be able to put this spread on at a much more favorable price. Now, for those of you who follow Tom and his trading tools, what he's teaching at Optionetics, these are additional tools for stocks that may not be covered that give you high probability options trades. So do I want to buy the Michael Kors options? No. Foot Locker is definitely on my radar screen, just looking for an additional pullback sideways to down movement over the next 3 to 5 days. The spread will get cheaper as volatility contracts. So let's look at a bearish personality change. Avalon Bay is in the real estate sector. It's an REIT that caters to rental properties, owns rental properties, caters to renters, and had a bearish personality change back in July as the stock was in the 185, 190 area, and it's continued to underperform as interest rates have gone up, because the real estate sector is one of those sectors that goes down in a period of rising interest rates. And there were plenty of opportunities, even after 6 months of underperformance, to use options to trade Avalon Bay from the short side. So bearish personality change, bearish power gauge rating. Look for the signals. In this case, it's our money flow sell signal, and enter an options position intelligently in the direction of the fundamentals and the technicals. Now, I promised you a signal that we've really taught almost exclusively to institutional investors. We just started exposing people to it on the webinar. It's the first time that the Optionetics people will have seen it. And we call it the secret sell signal that 95% of traders never see. It's a Chaikin bearish money flow sell alert. Now, money flow, as we told you, normally fluctuates around the zero line, so we color code it red and green. So here's Advanced Auto Parts. This chart ends in May of 2017. In January of 17, Advanced Auto Parts made a new high near that upper volatility band, and look at the Chaikin money flow. It didn't get above zero, it stayed red. That told us that smart money was getting out of Advanced Auto Parts under the cover of strength. We don't know who the buyers were. Could have been the public, could have been a brokerage firm recommendation, but smart, informed institutional investors or insiders were selling the stock. Could have gotten out right near the all-time high of 175. The stock then proceeded to drop, gave us some sell signals ahead of negative earnings surprises, and made its ultimate low at 78.87, down from 175. Almost a 50% drop in price. Now, I've updated the chart, although this isn't through today because I wanted to keep this news story up there. After 2 rounds of negative earnings surprises preceded by our overbought sell signals, that's a new 8-day high and a bearish stock, Raymond James, which is just a fine brokerage firm. We have a lot of Raymond James advisors who subscribe to Chaikin Analytics. Their research department, with the stock trading at about 92, lowered their rating on advanced auto parts from strong buy to market perform. That's why you need a tool like Chaikin Analytics or Tom's trading tools, because you can't depend on brokerage firms' research. Sometimes they'll be right and sometimes they'll be wrong. And the bottom line is we have so many Raymond James advisors who are subscribers to Chaikin because they're looking for something to supplement their own fundamental research. And Raymond James research is typically better than average. The stock ultimately went to 78 and now it's trading around 115, 120. Do not depend on Wall Street research. Be independent. Filter research through the Chaikin Power Gauge rating that you hear about on Mad Money or read about in the newspapers or on CNBC, and you'll be way, way ahead of the game. Now, I want to show you one more example of a money flow sell alert, and it came in a stock that we actually recommended on the long side in September. D.R. Horton, home builder that caters to first-time home buyers, made it our bullish stock of the week back in September when it was trading at 36.90. Now, the yellow arrow is where we recommended the stock, and let me walk you through my thought process because I think this is the pattern that we want you to come away with. Read the chart from the bottom up, please. Power gauge rating is bullish. It's outperforming the market. We know that because the heat map of relative strength is green. And look at the institutional buying. If I just keep us where it's supposed to be. Stock pulled back to its 21-day average after that buy signal about 2.5 weeks earlier, made it our bullish stock of the week, and it proceeded on a tear almost in a straight line to 53. Now, for most of that move, institutions continued to buy. But look what happened back in January when D.R. Horton made a new all-time high up around 53. Smart money was selling the stock. Same pattern we saw in advanced auto parts. This happens over and over and over again. So if you're still long the stock, you want to get out. If you were thinking of buying it, you want to ignore the next buy signal because you want to be trading with the smart money, not against it. And the stock dropped all the way down to 41 from 53. Pretty steep drop in a market where home builders were being touted in barons. But believe it or not, in the middle of that waterfall decline, barons was recommending the home builders. Now, we had a great report from Lennar yesterday, which spiked up 10%, and that has created some demand for D.R. Horton. It's a great company. It just got ahead of itself in terms of earnings. Next earnings report due out April 26th. Analysts are raising their estimates. Lennar, who's in the same industry, came up with a fabulous report and some very bullish background to the home building supply and demand situation, very positive. So we're looking perhaps for an opportunity on a pullback ahead of those earnings reports, April 26th, to perhaps buy a position in D.R. Horton. Now, everything we've looked at up to now is what we call the ideal setup. Fundamentals and technicals align. Now, Warren Buffett calls it the fat pitch, and baseball season started. We've been living it up here in Philadelphia with the Eagles winning the Super Bowl and Villanova winning the NCAA's basketball last week. Actually, it was this week. It seems like a long time ago, Joe. Joe went to Villanova. But the Phillies are not doing quite so well to start the season with the new manager. Warren Buffett is a big baseball fan. His idol in life was Ted Williams, the last batter to hit 400. And the reason was that Warren Buffett has famously said they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. You can wait for your pitch. Buffett calls it the fat pitch. We call it the ideal setup. And there's just one thing missing, which are the buy and sell signals that we've been covering throughout the course of the webinar. 6 pairs of buy and sell signals to give you timely exits and entries. And again, as with the classic bulls, how do you find them? Well, we have a dashboard. This is from our iPad version of our product. For the list of stocks that I'm following, about 6 of them gave buy signals coming into today. One of them was Adobe, which gave a relative strength buy. So here's what Adobe looked like this morning. Gave a relative strength buy, which is one of our favorite signals for options trading. It's accurate about 70% of the time. So now I look back at those relative strength signals on the chart and I see that they've been working. In fact, there was an opportunity to take advantage of volatility as the stock spiked down and then reversed back up and gave a relative strength sell signal. The bottom line is to trade more profitably, follow the signals. It's a discipline based on proven patterns, and that's a lot better than trading on your emotions. Again, that's why Tom's trading tools help you, because they take the emotion out of the option decision making. So this is an example of using the dashboard alerts to find profitable trading ideas. Now let's take a look at good defense, because good defense can often lead to good offense. And Herb Greenberg, who writes for CNBC and used to write for TheStreet.com, said 3 years ago that it's the stocks you don't own that matter. Think about that. It's not the big winners on the upside, it's making sure that you don't get stuck with the losers. So you do that by avoiding weak industry groups and sectors, by knowing what stocks not to buy. You improve your performance by eliminating bearish rated stocks based on the power gauge from your 401k plan or from your long side radar screen. You learn how to spot bearish personality trends and changes, and then you buy bearish put spreads on weak stocks, and now you're playing good defense. So one of the worst things you can do, in my view, is to bottom fish. When I did a live teach-in with Jim Cramer in New York in late October, I said in my presentation that bottom fishing is the most expensive sport in America. And TheStreet.com liked that and wrote a series of articles. One of the stocks that I mentioned back then was Mattel. And Mattel had given us a relative strength sell signal ahead of a bearish earnings report. And then when we did that live teach-in, Mattel was trading at about 15, proceeded to go all the way down to 11 and change on another bearish earnings surprise, and then out of the blue came rumors that Hasbro might take them over, another toy company. And the stock spiked up from 12 all the way to 18. So part of playing good defense is to not get sucked in on a rally like that. With the power gauge bearish, underperforming the market, you're not going to bottom fish and you're not going to get sucked in on these rallies. And look what happened. The stock traded back down and made new 52-week lows as Toys R Us went out of business. Along the way, there was another takeover rumor, and the stock spiked up yet again. You've got to avoid these. So playing good defense means not bottom fishing. It also means getting out of stocks like General Electric. Now, I wish the power gauge had been bearish because we'd look like a hero, but as I said earlier, relative strength stands alone as a bullish or bearish indicator. And this is a perfect example of that. Even though the power gauge was neutral, General Electric was underperforming the market all through 2017 and 2018. Now, when we did that teaching webinar in October, Jim Cramer was sharing his investment pain in General Electric. He did this on Mad Money, so we're not telling tales out of school. He said this is probably the worst mistake he's made in all of his 25 years on Wall Street or 30 years on Wall Street. And a lot of people stuck with General Electric, or even worse, tried to pick a bottom. Look at the relative strength sell signals. There are 6 of them on this chart. Every one of them was successful. It's never too late to sell a stock where everything's lined up against it. Earnings, relative strength, money flow, institutions continue to sell the stock to this day, even though rumors of a restructuring, of Warren Buffett possibly getting involved. These are great option signals. Can you see how you could have turned lemons into lemonade by buying a vertical put spread on a stock like General Electric, even after it's been underperforming for 12 months? You could have put the spread on here at $18 on the way down to 12 and change. Very profitable signals, but the bottom line is don't bottom fish, play good defense, and look for stocks like General Electric to trade on the short side. Another example, chemical stock, Albemarle in the S&P 500, bearish personality change here late in 2017. Institutions selling, you take that first sell signal, the relative strength sell. I actually made this my bearish stock of the week back in January. The stock was trading at 133, made its low recently at 88. 2 opportunities to trade it from the short side based on the relative strength sell signals. Very powerful signals with institutions selling the stock. The fear factor in doing a put trade goes away because you're trading on the right side of the fundamentals, the technicals, and the institutional money flow. Then you use the signals for your entries, and you've got the best of all worlds. And then one final example of playing good defense is in Facebook. Power gauge had been bullish. So part of these personality changes is to avoid putting your feet in cement, because we do that as investors and traders every day of our lives. We fall in love with stocks like Facebook. And we don't spot the personality change. Now, the power gauge never turned bearish, but it started to underperform the market back in January. So you want to get out of your long positions. And when you see a relative strength sell signal here in late February, with the stock trading at 178, you jump on it. And then you get another signal when it gapped down on the involvement in the potential involvement in the Russia investigation. The stock gave you a relative strength sell signal at 171 on the way to 150, and you're not agonizing over whether you should sell the stock, whether you've overstayed your welcome. You get out of it because of the bearish personality change, and then you go short on these signals, and you let someone else worry about whether it's going to rally to new highs. Now, today's rally in Facebook ran into resistance almost immediately. It gapped up today on who knows what revelation from Mark Zuckerberg. Didn't even get up to the 21-day average. Love to see another opportunity above 165 to buy a put spread on Facebook. Now, final section of the presentation tonight is profiting from volatility, because volatility equals opportunity. We like to find volatile candidates during earnings season, but the opportunities abound in a waterfall type decline like we've just lived through. We're looking to buy bullish power gauge rated stocks at distressed prices. So here's an example with Boeing. Boeing reported a great earnings report as the market was peaking in January. It spiked up to a new high, and then dramatic pullback on the first wave of that sell-off triggered an oversold buy signal. Stock was trading at around 320. You buy it, goes up to 360. You've got a choice. You actually had a bearish money flow sell alert here. Stock made a new all-time high above 360, and money flow stayed negative because we were in that waterfall decline. Institutions were not buying. So you ignore the next buy signal, but yesterday, what happened? Chinese government imposed $50 billion of tariff-related penalties. Boeing spiked down 20 points. Great opportunity if you were watching the stock to get in. Even though the power gauge rating is only neutral, it's still outperforming the market. And the stock reversed from a low of 311 to a high of 338 today. That's what we talk about when we say take advantage of volatility. If you've narrowed the universe down to a few stocks that you're monitoring for opportunities, you're going to find these opportunities in stocks like Boeing. And you'll also find them in stocks like Intel, which in the middle of that waterfall decline in early February gave us an oversold buy signal. Now, at the upper left of the screen is one of the newest features of Chaikin Analytics, the ability to pin a note to the stock. So I've been watching Intel since late February when it's held its 21-day average, while other stocks were making new lows. And then just the other day, I noted that it was oversold our long-term trend line with bullish divergence versus the S&P 500 and the semiconductor stocks. So we've given you a new capability to write a note, have it pinned to the stock so you can look back at what you were thinking on a given day, very almost like a trading journal for the individual stock. So Intel is an example of taking advantage of volatility. The stock sold down from 50.5 all the way to 42, gave an oversold buy signal. There's your opportunity. Take advantage of volatility. Another famous Warren Buffett expression that I'm sure you're all aware of is be fearful when people are greedy and greedy when people are fearful. This is what we mean by taking advantage of volatility. Bullish rated stock, outperforming the market. Take advantage of that buy signal to establish a long call, or from our point of view, a bullish vertical call spread, and then sell it when it gets up to the upper band. Take your profit in volatile markets. Don't hang on for the last dollar. Now, hearkening back to our playing defense is the fact that Advanced Micro Devices, which is a direct competitor of Intel, has had a bearish rating all year, 12 months of it, underperforming the market. So when you're looking for buying opportunities in Intel, you're looking for opportunities to be shorting Advanced Micro, AMD. And you just had a waterfall decline after an overbought sell signal where the stock went from 12 all the way down to $9. Now today there was a brokerage firm buy recommendation on the stock. Are you going to bottom fish in Advanced Micro or look for buying opportunities in Intel? Please tell me it's look for the buying opportunities. In fact, there may be another opportunity to short the stock because this brokerage firm recommendation is coming in the face of very, very weak fundamentals, technicals, and money flow. So the bottom line is buy Intel, short Advanced Micro, don't bottom fish. This is both playing good defense, spotting personality changes, and taking advantage of volatility. It's all rolled up into one package. Now, we talked about an award that we got from Benziga last May. It was for Best Ideas Platform at their FinTech Awards in New York. And what the Discovery Engine does for you, which is part of Chaikin Analytics, and the Discovery Engine is what we won the award for, is enable you to seed this ideas generating tool with a stock you like Michael Kors, which we looked at earlier. And I did this for a webinar that we did about 2 weeks ago, and immediately I saw 5 stocks in the apparel group with similar characteristic to Michael Kors, and one of them was Columbia Sportswear, COLM. Now, Columbia had a bullish personality change back in September, so if you had used the Discovery Engine back in October, you would have found Columbia at around $70 on the way to 80 in a market that was correcting. The stock has been making new highs and just recently triggered an oversold buy signal at around the 76 level, and today it was banging up against 80 or a new all-time high. gets to the upper band, I might take the profits, but the apparel group looks like it's turning around, as do the retail stocks. So Foot Locker, Macy's, Kohl's, Ross Stores, all positive. There's a trend there. Apparel and retail obviously go hand in hand. But this is the power of using our stock discovery engine to generate new ideas. We went from very positive feelings about Michael Kors to finding a new name, Columbia Sportswear, that you might not be as familiar with, and also Skechers and Deckers and so forth. So the ideas engine is really powerful. Everything we've been looking at is what we call Chaikin Analytics for both iPad and desktop. And it incorporates our 20-factor model that Tom has come to use on a periodic basis, almost daily. Our stock discovery engine to find new ideas. You could seed it with a bearish stock like Advanced Micro and get other bearish semiconductor stocks, or you'll find Intel and some of the bullish semiconductor stocks. Additionally, you've seen our screening tool and the options play module for new probability-based stock ideas. Chaikin Analytics is normally $2,195 for an annual subscription. You can go to chaikinanalytics.com/Gentile, but as a special for the Tom's Trading Tool Optionetics family, we want to take almost $200 off the price for a webinar special of only $1,999. chaikinanalytics.com/Gentile. The offer expires Sunday, April 8th. Or you can call the number on your screen that Joe will call out at the end of the webinar. Now, we got this testimonial from a relatively new subscriber who said 10x return in 5 days. In the 5 business days I've been using Chaikin, I've paid for the subscription over tenfold. And that's really the result of our entire team, customer success that Joe Bicella heads up, working with our clients whenever they need help in understanding the system. So in addition, you get our intraday charts, our earnings alerts, and my weekly market insights with bullish or bearish stocks of the week. Plus, as a member of the Chaikin community, you get member-only access to our weekly strategy webinar with our market strategist, Dan Russo. Get unlimited coaching and support, including one-on-one coaching if you need it, to align what you're doing with what Chaikin Analytics is best at. And then my colleague Dan Russo's morning insights help you understand what's going on in the market and position you for the trading day. Comes in before 9 o'clock every morning. So I'd like to make one additional offer for the Tom's Trading Tools community. If you subscribe by midnight tonight, not only will you get the price of $19.99, the discounted price, but we'll add 3 free months to your subscription. So 15 months for only $1,999. That's a $2,800 value. And it's available till midnight tonight. So please think about taking advantage of these tools that give you that directional edge. And with that, I'd like to thank everybody and turn it back to Tom for any closing comments that he has.
Yeah, thanks a lot, Mark. And you know, I was going to interrupt you here and there, but you're trading a lot of the same stocks that I'm trading, and some of them I'm seeing right off of Chaikin Analytics, and some of them we're seeing right off of our tools. So you know, it just goes to show that these two tools complement each other quite a bit. And guys, I asked Mark to do something extra special here, which is why he added on the 3 additional months for our group. This is something that he has never done outside of the Chaikin community and any other webinars, is to add on additional time. And so not only has he taken the price down a little bit, but he's added additional time on too. Thank you very much for that, Mark. I appreciate that. And, you know, like I said, guys, you know, I've known Mark for a while. He's really one of the first outside folks that we brought into our group. He is the first person that I brought in the group that actually has a software product that I think works very well with what we're currently using. So I wanted to, wanted to bring him in, let him show you what it is that he sees, also what I'm looking at as well, and see if it might be something that would fit your arsenal of tools. So, Marc, thank you very much. I appreciate it.
Tom, my pleasure. It's great to be with you again, and look forward to doing it again. So with that, turn it back to Joe Bacella to wrap up the webinar.
Excellent, gentlemen. Well, thank you so much for the presentation today. Again, in truth, that is 15 months worth of access to Chaikin Analytics from Marc for $19.99. That is a fantastic offer for, again, over a year's worth of access to the program. There were some questions during the presentation about training, how to understand the program. It's a perfect question because tomorrow we are hosting our last webinar of the week. That is our onboard session, and it's perfect for each and every one of you to hit the ground running with Chaikin Analytics. You're seeing on my screen the form or the link that I chatted out to you in the form to access Chaikin Analytics. We would love to have you join us. Again, just go right to chaikinanalytics.com/Gentile, or you can reach us at 877-978-6257. And again, we'll get you logged into the program. You'll have access within just a few minutes after registering, and then we will have you signed up for tomorrow's onboard session. So be sure to take advantage of this offer. Again, that's $19.99 for 15, not a full year, a 15 months worth of access to Chaikin Analytics. So again, thank you all very much for joining us. Keep an eye out for the recording tomorrow. But until then, we will see you on tomorrow's onboard session.